Stock analysts and economists are giving investors two very different views on the future for stocks and economic growth. Bloomberg's Eric Martin has been adding up the numbers in an exclusive Bloomberg survey, and our economics editor Kathleen Hayes also joining us this afternoon. Eric, tell us about the study. What did you find?
Mark, what we looked at was asking a very simple question, seeing that bottom-up stock analysts were saying that companies in the S&P 500 would increase earnings by 25% in 2010, and economists who were saying that the economy and GDP would only grow by 2.3%. So we looked at the historical relationship between GDP and earnings growth and found out that for each percentage point in GDP, you typically get 6 percentage points of earnings growth. So looking for a 2.3% increase in GDP next year would only give you about 13% earnings growth. That was telling us that analysts are expecting each point of GDP to add about twice the punch to the power to earnings that they have in the past. And
where was the disconnect coming from? Where's the difference?
Well, there's a difference in analysts who have typically been pretty bullish coming out of economic recoveries, and the economists who are looking at the big picture. And many of these companies may have strong earnings growth coming out of them, but on the whole, the analysts look like they're too bullish this time around.
Kathleen, what are folks telling you?
Well, let's take a look at, let's talk about the argument which supports this view of the analysts being too optimistic. We don't know for sure. We're not going to know for about a year. But if you look at the Goldman kind of view of the world, they're saying that they're predicting unemployment to get above 10% and stay there. John Hatzius has talked about, he's a chief economist at Goldman, of course, that there's a hangover from the unsustainable credit and housing bubble. The bearish economists expect people to pay down their debt, boost their savings, not have a lot of money to spend, and particularly not to see much income growth in the aggregate because they don't expect people to start hiring very much in this recovery. They expect a more kind of 90-91, 2000 style kind of recovery, which was long and slow and flat, instead of a 60s or 70s or 80s style recovery, which was a real sharp V.
Okay, for both of you, how could the analysts be right and the economists wrong? What's going on here?
Well, one thing, Kathleen and Mark, that the analysts are saying is that some of these companies, Intel, for instance, expected to boost earnings 50% next year, but Intel gets about half of its sales, two-thirds of its sales, rather, from Asia. So for a company like Intel, the U.S. consumer in this outlook that we're discussing has never been less relevant than it is today. They can do this with the purchasing in emerging markets, with the business growth outside of the U.S.
Right.
And that's a big argument for a lot of the analysts.
Is that what you're hearing as well?
Well, let's take one part of that. For example, overseas, we have a lot of excess capacity right now in manufacturing. So the naysayers, the skeptics on the economy, say that's one thing that will limit any kind of strong recovery, which doesn't exist in China. I think another difference between the bears and the bulls on the economy, the bears think the fiscal stimulus is going to wear out very quickly. Other people say, hey, the fiscal stimulus actually gets a little bit more in-depth by next year. It was weak this year, but all those shovel-ready projects, more of those will kick in. That's what's going to drive the economy forward. And let's bear in mind that some of the bears, like Goldman Sachs, which had a 1% third-quarter GDP forecast for this year, have already had to raise it for 3%. They've already admitted they were too bearish for this year.
Our economics editor Kathleen Hayes and reporter Eric Martin, thank you both. To be